Something moved in the markets this week that most investors never saw coming, and if history is any guide, it may already be too late to ignore it. Bitcoin, gold, and silver all shifted at once, in a pattern that has only appeared a handful of times before major turning points in the global financial system. To understand why this moment matters, we need to go back to where our last story left off. For months, gold had been sending a quiet warning moving in ways that historically preceded major shifts in the financial system, long before headlines caught up. That signal wasn't about jewelry demand or mining supply. It was about confidence in currencies and central banks, and in the ability of heavily indebted governments to keep the system standing. We explored how gold sits at a strange crossroads, both a physical commodity and a monetary asset, reacting less to today's news and more to tomorrow's expectations. Central banks, it turned out, had been quietly accumulating gold for years, not as a short-term trade, but as a long-term hedge against a financial order they were no longer certain would hold. Debt levels once considered manageable had become a structural burden, and every rate decision now carried consequences far beyond a single headline. We ended that story with a question that still lingers. If gold is warning that confidence in the system is shifting, what exactly are the world's largest institutions preparing for? Today, that question gets a new and much stranger answer, because gold is no longer moving alone. If you're new here, this is the kind of story we tell every episode, so hit subscribe now, because what's happening this week connects directly to everything we've been building toward. In the span of a few trading sessions, something happened that caught even seasoned analysts off guard. Bitcoin, historically the most volatile and unpredictable asset in modern finance, began moving in near lockstep with gold and silver, two metals that have represented monetary stability for thousands of years. For decades, these assets have lived in separate financial universes. Gold and silver answer to central banks, real interest rates. When all three start moving together in the same direction, with the same intensity, it isn't noise, it's a signal. And the last time markets saw anything resembling this kind of synchronized movement, it came right before a major repricing of risk across the entire financial system. That doesn't mean panic is justified. But it does mean something underneath the surface has changed, and the question every serious investor is now asking is simple. What do these three assets know that the rest of the market doesn't yet? Drop a comment below and let us know where in the world you're watching this from. This audience spans more countries than almost any other finance channel, and it's part of what makes this community special. To understand what's really happening, we have to look past the price charts and into the mechanics, driving them, the liquidity flowing through the system, the positioning of major institutions, and the fragile assumptions holding today's monetary order together. Because when an asset built on decentralized code and two metals with 5,000-year histories start telling the same story, that story is worth taking seriously. And it starts with a single overlooked shift in the bond market, one that quietly reshaped the incentives for every major asset class at once. That overlooked shift began in the bond market, where real yields the return investors earn after accounting for inflation started behaving in a way that hadn't been seen in years. When real yields fall, holding cash or bonds becomes less rewarding, and assets that don't pay interest, like gold, silver, and Bitcoin, suddenly become more attractive by comparison. This isn't a coincidence or a passing correlation, but because institutional capital now treats it as part of the same broader trade against currency debasement and policy uncertainty. That distinction matters enormously, and it's worth pausing on. A retail trader chasing headlines might see three unrelated charts moving up together and call it a coincidence. A portfolio manager at a major fund sees something else entirely, three separate expressions of the same underlying bet: that monetary policy is nearing a turning point, and that the value of holding cash is about to erode faster than expected. If you're finding value in how we connect these dots, take a second to like this video and share it. It genuinely helps this channel keep telling these stories in the depth they deserve. Central banks provide the clearest evidence of this shift. Over the past several years, monetary authorities in multiple regions have quietly built gold reserves at a pace not seen since the era before floating exchange rates. These aren't speculative bets. Central banks manage reserves on timelines measured in years, sometimes decades, and their accumulation reflects strategic positioning against currency and geopolitical risk, not an attempt to profit from short-term price swings. What's changed recently is that a similar institutional posture has begun extending into digital assets, large asset managers, sovereign wealth vehicles. Meanwhile, silver has quietly become the wild card in this story. Unlike gold, silver carries genuine industrial demand from solar panel manufacturing to electronics layered on top of its role as a monetary metal. That dual identity means silver often lags gold's monetary signals before catching up in sharp. Explosive moves, and many analysts watching the gold-silver ratio believe that catch-up phase may already be underway. When you consider these three forces together, falling real yields, sustained central bank accumulation, and growing institutional acceptance of Bitcoin. As a store value asset, the synchronized move stops looking strange and starts looking almost inevitable. The harder question isn't why this is happening. It's what happens next if these trends continue building at the same time. And that question becomes even more urgent once you consider what typically happens in the months that follow this kind of synchronized signal, a pattern history has already shown us before. History rarely repeats itself exactly, but it does rhyme in ways worth paying attention to. In previous cycles where real yields fell sharply while central banks quietly built reserves, the assets perceived as scarce and independent of government promises tended to move first, followed later by a broader wave of investor participation once the trend became impossible to ignore. That pattern, institutions first, retail last, has played out repeatedly across financial history, and it may be unfolding again right now, just across a wider range of assets than before. What makes this moment different is the presence of Bitcoin inside that pattern. In earlier decades, this kind of story belonged almost entirely to gold, with silver playing a supporting role. Today, a genuinely new asset class has entered the conversation, and its growing correlation with monetary metals suggests markets are beginning to treat digital scarcity and physical scarcity as two expressions of the same underlying idea: protection against the erosion of currency value over time. That doesn't mean these three assets will always move together going forward. Bitcoin remains far more volatile than gold or silver, and short-term corrections in any of these markets remain entirely possible, even within a longer-term trend. But the broader signal that capital is repositioning around the assumption that monetary conditions are shifting appears to be reinforced by multiple independent forces arriving at the same conclusion simultaneously, which is precisely the kind of convergence that has preceded meaningful market transitions before. If this kind of pattern recognition is exactly why you keep coming back to this channel, now is a great time to hit subscribe so you don't miss the next piece of this unfolding story. There's also a structural reason this convergence matters beyond the price action itself. When gold, silver, and Bitcoin move together, it becomes harder for policymakers to dismiss the signal as noise from a single, isolated market. A rally in gold alone might be explained away as safe haven positioning during a specific geopolitical event. A synchronized move across three fundamentally different asset classes is much harder to wave off, because it suggests the underlying driver isn't a single headline, but a shift in how capital broadly is thinking about risk and currency stability. That's why institutional investors are watching this moment so closely. Portfolio managers don't need certainty about what happens next month to adjust positioning today. They only need growing confidence that the probability of a major shift has increased. Small increases in that probability, multiplied across trillions of dollars of institutional capital, are enough to move markets meaningfully even before any official policy change is announced. Before you go, drop a comment letting us know where you're watching from today. Seeing this community span the globe is one of the best parts of making these videos. None of this guarantees a specific outcome. Markets can consolidate, correct, or defy expectations entirely. And no single signal, however compelling, removes the uncertainty that defines investing. What this moment does offer, though, is a rare, clear window into how the world's largest pools of capital are quietly repositioning for a future that looks different from the one most people have grown used to over the past decade. The real takeaway isn't that Bitcoin, gold, and silver moved together this week. It's that three assets built on entirely different foundations arrived at the same conclusion at the same time. And in financial history, that kind of convergence has rarely been meaningless. Whether this is the beginning of something larger or simply another chapter in an ongoing story, one thing is clear: